So, picture this. It's March 2026,
Right.
and it was supposed to be this totally routine, highly choreographed, super week for global finance.
Yeah, everyone knew it was coming, or they thought they did.
Exactly. The U.S. Federal Reserve, the European Central Bank, the Bank of England, they were all lined up to do these planned interest rate cuts, and then they just simultaneously slammed on the brakes.
Just a total abrupt halt.
Yeah, in complete shock,
Okay.
because they were looking at their economic dashboards, and the instruments were showing a reality that honestly shouldn't be physically possible.
The panic in those boardrooms, I mean, you could practically feel it through the reports. Policymakers were suddenly staring down the barrel of a terrifying economic buzzword.
Oh, yeah.
A condition that just fundamentally breaks all the traditional rules of economics. It basically renders their usual tools completely useless.
And that buzzword is exactly what we are decoding today. So, welcome to this deep dive. We are taking this massive stack of sources. I mean, we've got historical macroeconomic research. We've got up-to-the-minute 2026 market reports from Tiger Capital.
Terrain, Deloitte, the Fed itself.
Right, all of them. And we're using them to figure out exactly what stagflation is. We're going to explore why those central bank alarm bells are ringing so loudly right now. And, most importantly, exactly how this impacts you.
Because it does impact you.
Totally. Your daily life, your wallet, your investment portfolio.
Yeah, because when central banks are, flying blind, the shockwaves eventually reach everyone. You really need a map for this kind of environment because the standard financial playbook actually becomes dangerous.
It really does. Okay, let's unpack this, because before we can understand why the Fed and the ECB are just frozen in shock right now, we have to understand the specific disease they're so terrified of catching.
Right.
So what exactly makes stagflation the ultimate macroeconomic nightmare?
Well, the term itself is a portmanteau. It's a combination of stagnation and inflation.
Stagnation and inflation, okay.
It's this toxic, simultaneous combination of stagnant economic growth, high unemployment, and persistently high inflation all at once.
Which is wild.
It is. And to understand why central bankers lose sleep over this, you have to look at the foundational rule they rely on, which is the Phillips curve.
Oh, I can actually jump in on the Phillips curve, because for decades, really since World War II, this was basically the law of gravity for modern economists.
Exactly. The absolute baseline.
Right. And the curve states that inflation and unemployment have this strict inverse relationship. So if an economy is booming, everyone has a job, unemployment is low.
But all those paychecks mean more money chasing goods.
Exactly. So you get inflation.
And then the reverse is equally reliable under that model. If the economy slows down, people lose jobs, consumer demand drops.
Then nobody's buying anything.
Right. And because nobody is buying anything, companies are basically forced to slash prices just to clear out their inventory.
Makes sense.
So you get high unemployment, but inflation cools off.
Yeah.
The fundamental belief was that, you could suffer from one or the other, but the math dictated you could never have both at the very same time.
Which brings us back to that broken dashboard in March 2026, because stagflation completely defies the Phillips curve. It just breaks that law of gravity.
It shatters it.
It sounds like driving a car where the engine is overheating, which is the inflation, but the transmission is completely stalled out, representing the stagnation. I mean, you shouldn't be able to overheat while sitting still.
That's a great analogy.
Yeah.
And what's fascinating here is how this dynamic creates an impossible, paralyzing dilemma for policymakers.
Because what do they even do?
Right. Think about the primary weapon a central bank has. It's the interest rate. If they decide, okay, we must fight this rampant inflation, they raise interest rates to cool the economy down.
But if the economy is already stagnant?
And people are actively losing their jobs, raising the cost of borrowing will just crush those struggling businesses and cause mass layoffs.
Wow. And if they blink, if they look at the unemployment lines and say, we need to save these jobs, let's cut interest rates and print money to stimulate growth.
They pour gasoline directly onto the inflation fire. Prices just spiral even further out of control. Stagflation forces that entire Phillips curve to shift outward.
Oh, man.
Yeah, every traditional cure a central bank applies actually feeds the other half of the disease.
It's a total economic catch-22. But, this isn't just a theoretical model sketched out on a whiteboard at the Fed. When this broken rule actually manifests in the real world, it leaves deep generational scars.
It really does.
So to really grasp how devastating this can be for you and your savings, we have to look back at the historical track record, right?
Yeah, we have to. And the origins of the concept actually trace back to 1965.
1965, okay.
Yeah, British politician named Ian MacLeod coined the term while he was speaking to Parliament during a period of really severe economic distress in the UK.
What did he call it?
He warned they were facing the worst of both worlds. Not just inflation, not just stagnation, but this horrifying blend of both.
The worst of both worlds. That paints a picture. But the era that gives modern economists actual night terrors, at least according to our sources, is the 1970s.
Oh, definitely.
That is the textbook poster child for stagflation.
Right, because the 1970s crisis perfectly illustrates the primary trigger for almost all stagflation events, which is a massive supply shock.
A supply shock.
Yeah. In 1973, the global economy was hit by the OPEC oil embargo. The fundamental raw material required to run the industrialized world was suddenly artificially constrained.
Then the mechanism there is just brutal. I mean, it's not that consumer demand was so hot it was driving up prices. It was that the physical energy required to, manufacture a product, put it on a truck, keep the lights on at the grocery store, it suddenly cost a fortune.
Exactly. And that price increase just gets passed down the line until it hits the consumer.
And the resulting data from the sources was just grim. During that period, real GDP growth in the U.S. averaged just 2.3%. It was barely sputtering along.
But inflation averaged 9.2%.
Which is huge. And it eventually peaked near a staggering 17%.
Which is just, almost unimaginable today. 17% inflation while the economy is basically stalled.
Yeah. Our sources mention a metric from that era called the misery index, which, it's such a perfectly bleak descriptive name.
It really is.
You literally just add the unemployment rate to the inflation rate. And in the 70s, it reached agonizing levels. People were losing their livelihoods, and whatever cash they had managed to save was rapidly becoming worthless.
And to understand the severity of the disease, you just have to look at the cure.
Right. How do they fix it?
Well, in the early 1980s, Federal Reserve Chair Paul Volcker decided the only way out was to shatter the public's baked-in expectation that prices would just keep rising forever.
So what did he do?
He raised interest rates to an unprecedented 20%.
Wait. So Volcker basically had to put the entire U.S. economy into a medically induced coma just to cure the disease.
That is the grim reality of it, yeah. Volcker's sledgehammer triggered a brutal recession. Unemployment hit 10.8%. But it was the only proven method to destroy the psychology of inflation. Because once everyday people expect prices to rise, they demand higher wages to survive.
Right, which makes sense from their perspective.
Completely. But then companies have to raise prices to cover those new higher wages, and you lock into this toxic wage price spiral. Volcker had to stop the economy entirely to break that loop.
And it's crazy because the 70s aren't even an isolated anomaly. Our sources show this popping up globally whenever supply shocks collide with bad monetary policy.
Let's say.
Like, look at Zimbabwe under Robert Mugabe. He expelled all those skilled commercial farmers. That wasn't just a political move. It was a massive agricultural supply shock.
A total collapse of their food production.
Yeah, you don't just lose the crops. You lose the export revenue, which destroys the currency. And then the government just printed money to keep the lights on, resulting in hyperinflationary stagflation.
We also saw a more moderate but highly instructive version in the UK around 2010 and 2011.
Oh, right.
Yeah, they experienced about 5% inflation paired with a really depressed, stagnant economy. And a major driver there was a heavily devalued pound.
Let's break down the mechanics of that, actually, because it's crucial. How does a devalued currency cause stagflation?
Well, if your country imports its energy and most of its goods, a weaker local currency means every drop of oil and every imported product suddenly costs drastically more to bring across the border.
Oh, I see. So it creates a localized supply shock.
Precisely. Combine that with high taxes depressing consumer spending, and you have the UK's 2010 stagflation scenario. And, modern-day Turkey is navigating an even more extreme version of this right now, where structural economic issues meet a central bank that just refuses to raise rates appropriately.
Wow. So knowing that it usually takes an economic coma to cure this, we really need to look at the current 2026 data. Because the whole reason central banks hit the panic button in March is that the exact same warning lights are flashing again today.
Yeah, if we connect this to the bigger picture, the parallels to historical supply shocks are uncanny. A 2026 report from DePaulo in May outlines 4 distinct warning signs of an impending stagflationary environment.
And policymakers are watching all 4 blink red.
All 4.
So rather than just listing them, let's look at how they compound on each other in the real world. It starts with the first sign, which is sticky energy and food prices.
Right.
The sources show Brent crude oil recently surging past $95 a barrel. And just to remain completely impartial regarding the geopolitical realities here, this price spike is being entirely driven by tensions in the Middle East and a blockade of the Strait of Hormuz.
Yeah, the physical oil is just harder to get, so it costs more.
Mm.
That is a textbook supply shock, mirroring 1973 almost perfectly.
But the pain doesn't stay at the gas pump, does it?
No, it moves to the second sign, which is real wage decline.
Ah.
So nominal wages, the actual dollar amount printed on your paycheck, that might be creeping up. But inflation is rising significantly faster.
So your actual purchasing power is falling.
Exactly.
Here's where it gets really interesting, though, because people are experiencing a massive psychological disconnect. You get a 4% raise at work, which, feels great on paper.
You feel like you're getting ahead.
Right. But then you go to the grocery store and your weekly staples cost 8% more than they did last year. You are working just as hard, making more money, but you are tangibly poorer.
It's exhausting.
That explains why consumer confidence surveys are absolutely plummeting in the 2026 data.
Completely.
Yeah.
And that psychology of feeling poorer triggers the third sign, which is weak GDP paired with rising unemployment.
How does that chain reaction work?
Well, when consumers realize their paychecks don't stretch as far, they immediately stop spending on discretionary items.
Like restaurants, vacations.
New electronics, yeah.
Yeah.
Businesses see their sales plummet, so they freeze hiring, and eventually they start laying people off. The Q4 2025 data confirms this sequence perfectly.
Because GDP fell to an annualized 0.7%.
Which is an incredibly weak showing, while unemployment started ticking upward.
Which brings us to the fourth sign, the one that paralyzed the central banks in March. Persistent core inflation despite tight monetary policy.
Yeah, this is the scary one.
The Fed and the ECB have been keeping interest rates relatively high to kill inflation, but it just isn't working.
Because they are fighting cost-push inflation. Prices aren't rising because consumer demand is red hot. They're rising because the inputs, the oil, the shipping, the raw materials are fundamentally more expensive.
And central banks can't print more oil.
No, they can't. They can't unblock a shipping strait with a 25 basis point interest rate adjustment.
That is the Fed's trap. The sources explicitly note that the era of forward guidance is completely dead.
Well, gone.
For years, central banks would tell the market exactly what they plan to do 6 months in advance to keep things calm.
Now, they are flying completely blind. They're operating meeting by meeting, absolutely terrified that pulling the wrong lever will either cause hyperinflation or a deep recession.
So with the macroeconomy flashing all these warning signs and central bankers sweating in their boardrooms, we have to translate this down to the individual level. How does a stagflationary environment actually alter your personal financial reality?
Right, because to understand the impact on your wallet and your investments, we have to separate a normal recession from stagflation.
Okay, let's do that. In a standard recession, demand collapses, so prices fall. It's deflationary.
Right.
In that specific scenario, cash becomes king. If you hold on to your dollars while the economy crashes, those dollars actually gain purchasing power because cars, houses, and goods are all getting cheaper.
But in stagflation, the rules invert completely. You might lose your job, but your groceries and your heating bill are still getting more expensive every single month.
So your cash is actively losing its value while you just sit on it.
Exactly. Hiding your money under the mattress is mathematically equivalent to setting it on fire.
And the usual safe investments aren't safe either. Let's look at bonds. A traditional bond pays you a fixed percentage yield over time, right?
Yes.
But if inflation is running at 6% and your bond is only paying you 4%, your real yield is negative. You are locking in a guaranteed loss of purchasing power.
It's a losing game.
Yeah.
And the stock market offers very little shelter for the casual investor either,
Yeah.
particularly when it comes to growth stocks and high multiple tech companies. They get absolutely crushed in this environment.
I can break down the mechanics of why tech stocks suffer so badly, actually. It really comes down to the discount rate.
Oh, yeah.
Because tech companies are often priced based on these massive profits they promise to make, like 5 or 10 years from now. But when inflation is raging today and interest rates are high, the math completely breaks down.
The future money isn't worth as much.
Exactly. Those future dollars they promise to earn will be worth pennies by the time they arrive. Investors realize this and immediately dump the stock.
So if cash is burning, bonds are sinking, and tech stocks are crashing, where does capital actually flow?
Right. There have to be winners.
There are specific safe harbors. Real estate is historically a strong winner, provided you have a fixed-rate mortgage.
Okay, why is that?
Well, the physical asset, the house itself, inflates in price, along with everything else in the economy, but your debt, that fixed mortgage, gets inflated away.
Oh, wow.
Yeah, you're paying back the bank with currency that is worth substantially less than when you originally borrowed it.
That makes perfect sense. The debt actually becomes cheaper to service over time. What about equities, though? Is the entire stock market awash?
Not entirely. Equities in value stocks and defensive sectors tend to survive and even thrive. We're talking about healthcare, utilities, consumer staples.
Essentials.
Right. People still need their blood pressure medicine, they still need electricity, and they still buy toothpaste, regardless of the broader economic stagnation.
And those companies have what we call pricing power.
Exactly. They can raise their prices to match inflation without losing their customers.
And we absolutely cannot forget commodities. If stagflation is being driven by a physical shortage of raw materials, then owning the raw materials is the ultimate defensive play.
Absolutely.
The sources point heavily to industrial commodities like oil and copper, and monetary commodities like gold and silver.
And those monetary commodities thrive because they are hard assets that exist entirely outside the fiat currency system.
Fiat money being currency backed only by government decree, like the US dollar or the euro.
Exactly. When trust in the government's ability to manage the economy falters, investors flock to assets that governments cannot simply print more of.
Which perfectly explains the massive shifts we are seeing in foreign exchange. Traditionally, the US dollar acts as the ultimate safe haven during a global crisis. But because inflation is directly attacking the purchasing power of the dollar right now, it's losing that sole safe haven status.
For forex markets are reacting violently to the oil shock.
They really are. Energy exporting currencies like the Canadian dollar and the Norwegian krone, they're appreciating rapidly because their local economies actually benefit from $95 oil. Meanwhile, the Japanese yen and the Swiss franc are stepping in as the primary beneficiaries of all this market panic.
It's a massive realignment.
So what does this all mean? It means the defensive playbook requires a total strategic pivot.
And this raises an important question. How do you adapt your portfolio without panicking?
Right, nobody wants to panic.
No. It requires emphasizing flexibility over rigidity. You move away from long-duration assets and fixed yields, and you move toward real assets, companies with pricing power, and commodities that act as natural hedges against inflation.
Okay, we know how to board up the windows and protect our portfolios, but how long do we actually have to stay in the bunker? What are the top financial forecasters predicting for the rest of 2026? Are we looking at a lost decade or just a terrifying blip on the radar?
Well, the forecasts in our sources are sharply divided. They offer two very different lenses on our immediate future.
Let's hear the bad news first.
The pessimistic view is anchored by Tiger Capital. They use something called a regime classification model. Think of it as a highly complex statistical tool that ingests millions of data points, employment numbers, shipping costs, energy futures to categorize the current economy into a specific regime or state.
And what does the model say?
Right now, their model assigns a massive 65% probability to a persistent stagflation regime running all the way through year-end 2026.
Wow, 65%. And that institutional pessimism is actually backed up by the Federal Reserve's own internal framework.
Yeah, that was striking.
One paper noted that by Q2 of 2025, the probability of at least mild stagflation had already spiked to 59%, heavily driven by supply risks and global tariffs. When the very institution tasked with preventing stagflation says it's the most likely outcome, you have to pay attention.
You really do. The data is undeniably concerning. However, groups like Terrain and Deloitte offer a vital counterweight to the panic.
Okay, some good news.
Yeah, they emphasize a crucial historical reality. True, entrenched stagflation is incredibly rare. When it does happen, it is usually a short-term phenomenon, not a permanent paradigm shift.
And they use a metric called the stagflation index to prove this, right?
Yeah.
It's simply the misery index we talked about earlier minus the rate of real GDP growth.
Exactly, and the contrast is stark. If you look at the 1970s, that stagflation index averaged 13.4.
13.4, okay.
But recently, even with all these modern warning signs flashing red, the index was only hovering around 3.7.
Oh, wow.
Yeah, that is a massive difference in actual systemic severity.
Terrain also points out a structural difference in the inflation itself. In the 1970s, the inflation was entirely broad-based. The price of literally every manufactured good, every service, every raw material went up every single month.
Right, it was everywhere.
Today, the inflation we are seeing is heavily concentrated in services and very specific commodities. Goods inflation would need to accelerate at a terrifying, unprecedented pace to truly repeat the 1970s.
That's a great point. And the strongest argument against long-term doom, which is championed by Deloitte, revolves around long-term inflation expectations.
How so?
Well, in the late 70s, inflation psychology was utterly baked into the culture. People expected prices to double, so they acted in ways that ensured prices doubled. Today, financial markets and institutional forecasters still largely expect inflation to eventually cool down. The psychology hasn't completely broken yet.
See, I have to push back on that, though.
Okay, why?
Because the sources clearly mention that web searches for the word stagflation have jumped sharply. If everyone you know is Googling it and consumer confidence is dropping precisely because everyday people expect their finances to worsen, aren't those consumer expectations already becoming unanchored?
That's a fair question.
I mean, if the public believes a crisis is coming, doesn't it become a self-fulfilling prophecy?
You've hit on the exact mechanism that keeps those central bankers awake at night. The Google search data is basically a proxy for fear.
Right.
If consumers fundamentally expect higher inflation to ruin their standard of living, they demand higher wages to compensate. Companies, facing those higher labor costs, raise the prices of their goods to protect their profit margins.
And there's that dreaded wage price spiral again.
Exactly. Once that psychology takes hold at the street level, as Paul Volcker showed us, it takes an economic earthquake to dislodge it. That is the exact threshold we are teetering on in 2026.
Man, it really brings our deep dive full circle. We started by looking at a macroeconomic engine that was simultaneously stalling out and overheating, completely baffling the central banks.
Yeah.
We traced the ghosts of the 1970s, explored the brutal mechanics of supply shocks, and tracked the exact same flashing warning lights, the $95 oil, the stagnant GDP, the falling real wages into our present reality.
And we also translated those high-level fears into actionable reality. We explored the mechanics of why cash and tech stocks burn in this environment, while real estate, defensive value plays, and hard commodities provide a vital parachute.
But, we've been talking this whole time about what the folks in Washington, London, and Frankfurt are doing wrong. We've framed stagflation as a massive failure of national policy or global supply chain.
Which is how it's traditionally viewed.
Right. But before we wrap up, I want to leave you with a completely different map to look at. A provocative thought to mull over from the legendary urban planning activist Jane Jacobs.
Oh, this is a fascinating perspective. Jacobs argued that our macroeconomic theories fail to explain stagflation because they focus on the wrong entity entirely.
They focus on the nation rather than the city.
Exactly. She theorized that stagflation happens precisely when nations fail to develop what she called import-replacing cities.
Think about the mechanics of that. Her theory was that if a nation relies on diverse, dynamic, local urban economies, cities that can actually balance their own local production with the things they import from outside, they create a natural built-in flexibility.
Right.
And that localized flexibility essentially immunizes the region against national stagflation.
It's a brilliant lens. It suggests that economic resilience isn't just about what a Federal Reserve chairman is doing with interest rates on a Tuesday afternoon. It's about the structural, localized health and the production capacity of the actual community where you live.
So here is the question we want to leave you with as you review your own portfolio. What if the ultimate protection against macroeconomic disaster isn't who is running the central bank, but the economic resilience, diversity, and self-sufficiency of the specific city you choose to live in?
That's powerful, because when the dashboard on the national economy breaks, the strength of your local economy might just be your most valuable asset.
It's definitely something to think about as you navigate the turbulent markets ahead. Thank you for joining us on this deep dive. Stay curious, keep questioning the consensus, and we'll be right here waiting to dive deep with you again next time.